To date, philanthropic investors have mobilized $19 billion of capital into blended finance. More specifically, foundations have participated in almost a third of all blended transactions, and together with NGOs, represent 25% of all concessional financing and blended finance structures. These investors play a unique role in blended finance transactions because philanthropic capital has relatively low expected returns and a high risk tolerance, which means it is generally more flexible and experimental. While comprising only 10% of all financial investments into blended finance transactions, philanthropic investors provide an outsized source of concessional capital, which is shown to be quite muscular in its catalyzing effect. So what role do philanthropic investors play in blended finance? First, philanthropic investors can provide design stage grant capital, which can help create pipelines and solve for the lack of deals in the market by facilitating transactions that are deemed too risky. This has been proven to have an explosive effect. For example, Convergence's design funding program has awarded over $8 million of grant funding to 31 blended finance solutions, which have gone on to mobilize over $1.5 billion. Next, because of the high risk tolerance, philanthropic investors are able to experiment and innovate in new sectors and geographies, which lays down a demonstration trail to drive new activity in the field. This is evident as philanthropic capital outpaces the general trend in blended finance transactions in health by over 2-to-1 and in education by just under 2-to-1. Further, 40% of philanthropic allocations have been made in the sub-Saharan Africa region, 21% in South Asia, and 16% in Latin America and the Caribbean. Finally, philanthropic investors are also more likely to participate in smaller deals and serve as a tool to better address more targeted development objectives in lower income countries or nascent environments that may not have the financial ecosystem to support larger ticket size investments. For example, 40% of deals they participated in have an investment size of $25 million or less. In the world of development finance, capital allocation decisions are made around the balancing of risk and return. And due to the flexible nature and catalytic potential of their capital, philanthropic investors play a critical role in this balancing of risk and are vital to the blended finance market.